This is Chapter 6. We're going to be analyzing and journalizing payroll transactions. And this is now getting into some accounting that you hopefully have looked at before, because we're doing some journalizing. And you've worked with doing journal entries for payroll. But now you're going to actually have to calculate the numbers that you journalize, as opposed to getting them from some problem in the book. And this is the last chapter in this section, so we're going to then be moving into QuickBooks. So enjoy this payroll section. You'll probably like that it's finishing up, because it's been pretty intense. Accounting for payroll transactions. This is learning objective 1, and payroll requires entering data, and you do it in this order in the following places: Payroll Register, Employee Earnings Records, the General Journal. And in the General Journal, you journalize gross wages and withholdings. You journalize the payroll taxes and workers' compensation. And you journalize the period end accruals. Then you post these journal entries to the general ledger. And so we'll go specifically to the payroll register. We're going to look at each one of those. First, you record information in the payroll register. There's an example in Chapter 1, page, well, it depends on what year you're in, but anyway, in Chapter 1. But there's also one in Chapter 6 at the bottom of the page. And if you look at that, it shows all of the employees in rows, and it's going to show the following information for each one of them. You've got your gross wages, which you can see in there, that any taxes withheld and other deductions, and then the net pay. So the payroll register shows the total of gross wages and the total of each deduction and the total net. So those are at the bottom. And I have to say, at the bottom of the page, the way that this exhibit, this figure is in the book, it's hard to read, because they put 3 numbers in one column. And so instead of being something like 22,400 something, it looks like 224 something. So anyway, it's a little tricky, but don't let that intimidate you. You've got to look at it and see where they're coming up with those numbers. Because when you've completed the payroll register, you have to foot or prove the payroll by ensuring that the columns and the rows all total to the bottom right-hand number. So the way that works is, all of the columns are added up, and you've got totals at the bottom. Then certain of those totals should add up to equal the grand total. And in your textbook, they give an example of a proof of how you would make sure that the total earnings and the total earnings are accounted for. And you will see, if you look at that proof, exactly how that works. It's better for you to look at than me to try to explain it without having you see one. Then you're going to use this payroll register to journalize. So we'll come back to that in a minute. But first, the second thing that you do is you transfer information to the employee's earning records. So from the payroll register to the earnings records. And the reason you need to have this is you've got to have it to track the cumulative totals, both for wages and taxes. And you also need to enter a row of data for each pay period. You'll see, like for the week ending January 17th, you're going to have a row of data. And this is important because you've got different wage caps for FUTA, SUTA, and OASDI taxes. And you've got to track the cumulative total so that when you hit those caps, you no longer are withholding or paying those taxes. And you also need to track the cumulative totals for when you do, you issue W-2s on there, total wages, total taxes withheld, and for the quarterly reports. That's where that information comes from. You've been working doing problems at the back of the book, and they give you that information, but in the workplace, you're actually going to get it from the earnings records. This earnings record is also used to prepare payroll analysis for various internal and external reports. It could also be used to settle an employee grievance. If there's an issue with their salary, you have to go back and look, and it could be 20 years old or 20 years previous, but you've got a history of basically all their wages and the taxes that have been withheld. So when you record the gross payroll and withholdings, you're going to do it in a journal entry. So you debit the gross payroll, and it's usually something like payroll expense. And then each withholding tax is credited to a liability because you owe that. You've withheld it and you owe it to the government, but you haven't paid it yet. When you pay it, there will be a separate journal entry. And then any of the other payroll deductions become liabilities, whether it's health insurance or let's look at this. Group life insurance, health insurance. Believe it or not, some companies will withhold money and then forward it to buy government savings bonds. This is very popular in the war years, back in World War I and World War II, and it's still done. Union dues, I have withholding from my payroll because I belong to the Faculty Association, and I think it's at $2 every time I get paid, so that's forwarded. Wage garnishments, which we'll talk about more in a minute, and any pension and retirement contributions. So all of these are liabilities to the employer because they've withheld it from the employee, and they have to then write checks or transfer electronically the money due for these. Garnishments, let's look at those. A creditor can go through the courts and seek repayment of his or her money by garnishment, which means the employer owes money or the employee owes money to various entities, and if the employee isn't paying, then the employer, the creditor goes through the courts and they basically get it withheld from the employee's paycheck before the employee even sees it. A garment, the employer must withhold funds from the employee's paycheck and then submit it to the proper authorities. So the garnishments are limited based upon the Consumer Credit Protection Act. Other than for federal tax levies, meaning you can't take 100% of the employee's paycheck for garnishments unless it's a tax levy. And there's a priority because a lot of times people that aren't so good with money, they owe money all over the place, and they might have many different places that have garnished their wages. So like who gets what is what this looks at. So the first one is priority. When we say attachments, it basically means they're attaching the salary to pay off whatever the bill is that's owed. So when you take out bankruptcy, a lot of people do a Chapter 7, which is when all your debts are released. But a Chapter 13 basically reduces your debts and puts you into a payment plan. So that's what we're talking about here. It's a Chapter 13. Any debts owed for that have to be paid. Then federal taxes or child support, whoever puts the garnishment order in first. gets priority there. And then third, just a regular creditor, like if you bought furniture on account or something, that would be owed. Or a student loan, or federal administrative wage garnishments. Those are all could be withheld before the person actually gets their paycheck. But a Chapter 13 bankruptcy order has highest priority over all of the other claims. So let's look at child support. The Family Support Act requires immediate withholding for child support payments, which makes sense. And the employer can withhold a state-mandated fee for administration of this, because it takes some manpower for the employer to have to even do all of this paperwork. And so if, like for instance in the state of Utah, they might tell the employer that they can withhold a certain amount from the employee's check to compensate them for doing this withholding of the child support payment. And some states now require electronic submission of garnished child support payments. So, you know, they're trying to make it so that the people, the deadbeat spouses, is what often they're referred to, pay their child support, for crying out loud. The maximum amount that can be withheld from a person's weekly disposable earnings, which would be like their net income, varies according to different support orders, but it can be between 50 to 65% of their disposable earnings, depending on what other obligations they have. Like they might owe money, but their wages haven't been garnished for those debts, but they have debts that also have to be paid, and the number of weeks in arrears. And the number of weeks in arrears means how far behind they are on child support. So what about federal taxes? This is people that file their income tax return, but they don't pay their taxes. And so the IRS can garnish their wages. It takes second priority after wages withheld for child support if the wages withheld for child support, if the child support garnishment was received prior to the tax levy. If not, then the tax levy takes precedence. And if the debtor declares bankruptcy, then the levies are suspended, meaning they don't have to pay them. Well, they're not released, but they're suspended. And whether they have to pay them or not is another discussion for another time, but not this class. So the amount of the taxpayer's standard deduction is only the amount that's exempt from a federal tax levy, which means they could take your entire pay, except they have to, if you're single, they have to, $5,950 is exempt, and $11,900 if you're married. And the IRS publishes tables that can be used to figure out the exact amount that's exempt from the levies, from the tax levies. And the employer is required to withhold until they get a Form 668D, which is basically coming from the IRS saying you're released from withholding this anymore. So, you know, if the employee comes in and says, hey, I'm done, I paid it off, you don't have to withhold it anymore, that's not good enough. The employer has to receive that notice. So there's also some garnishments. Actually, no, I think we're done with garnishments. These are just straight up retirement contributions. So pension plans that involve employee contributions result in a liability for the employer. Now, a pension is set up by the employer as opposed to a retirement contribution, which would be for the employees contributing to an IRA or a Roth or a 401k. A pension plan often is set up by the employer. The employer pays into it, and sometimes they will also have the employee make contributions, and this could be required or voluntary. So when those contributions have to be made, they're recorded in a payroll entry. And they become a liability. The debit is to some sort of benefits expense or payroll or retirement expense or pension plan expense, and the credit is to a liability. The Pension Protection Act of 2006 gives a company the ability to automatically enroll employees in a company's plan and deduct contributions from the pay. So it might be, when you hire somebody, you've got to tell them, you're going to have to withhold. We're going to have to withhold money from you, and maybe the employer matches it or something like that.